Hello everyone and welcome back to my channel. In this video, we're going to talk about one of the most intriguing tech companies that has been trading on the Nasdaq, Canoo Inc., trading under the ticker symbol GOEV or GOEV. It has been one of the rising stars back in 2020 when the EV sector seemed to be on the verge of taking over the universe. This is not how things ultimately played out, and today, after the collapse of the bubble, people are left wondering whether there's any possibility for recovery. Before this video continues, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. In a reflection on the recent market trends, the share price of Canoo has been valued at around 18 cents a share, showcasing a 18% downturn over the past 5 days, a 31% decline in the last month, and a substantial 74% drop over the preceding 6 months. This marks a historical low point for Canoo with no substantiated low levels observed thus far, undergoing a notable metamorphosis from the research and development phase to the active business phase. It is a pivotal question for investors, and we all need to face the fact that maybe it's possible that 2024 is going to be a very challenging year for the company. Because as the revenue generation, or in other words, the operating phase began, a lot of notable efforts have been reflected in order to fulfill the initial batch of 1,000 units agreed with the state of Oklahoma. Now, 1,000 is not just 1,000, it means up to 1,000. In other words, it's used as a grand announcement which may or may not translate into actual deliveries of that amount. So, to bolster its financial standing, Canoo has strategically decided to raise a $45 million capital raise through preferred stocks and warrant subscriptions. This move has played a crucial role in averting a potential cash crisis, considering that despite securing over $1 billion from investors, companies found itself with only $8 million. So the injection would bring about another 53 million piece as of September the 30th. When we look at Canoo more closely, it dropped by 98.6% from its 2021 peak. The most recent quarter showcased a burn rate of about $62 million a quarter, which is much better than when they were burning about $120 million a quarter. So the real intrigue centers around the revenue growth projections. They currently estimate a minimum revenue of $1.4 million in 23, skyrocketing to about $270 million in the year that we're currently in, and $1.3 billion in 2025. Now, if realized, those figures may position Canoo as a pretty attractive investment, but the journey has a lot of challenges ahead. So, despite those optimistic revenue forecasts, analysts do anticipate a loss of 41 cents per share in 2024, and in 2025, it might go to something like 20 cents loss per share. The anticipated gross profit is about 4.4% in 2025, which would suggest that they're making an effort towards profitability. But we have to acknowledge the fact that Canoo is still in its earlier stages, which demands a lot of patience as it navigates the intricacies of the EV industry. The primary question looming at this juncture is whether the market will demonstrate sufficient patience for Canoo to reclaim its former standing and exhibit its capability to deliver a competitive product. Despite having made a lot of efforts to acquire equipment and so on, Canoo's shares did not really mirror the optimism that the company tries to put forward. This is probably attributed to the absence of significant catalysts benefiting the sector and Canoo's yet to be demonstrated development triggering increased market demand. Like a thorough examination of the company's balance sheet would show that cash is going to be a real problem in 2024. And the substantial shareholder dilution, with shares outstanding surging from 150 million to more than $600 million, would indicate a significant stock issuance issue and like a lot more pressure to keep fueling the company's growth. The, the company's current dynamics and financial landscape does present a very complex narrative. So it tries to grapple with historical lows and more endeavors to position itself for future growth. We must be super careful. The industry's inherent challenges, along with the company's specific challenges ahead, need to be considered before you make a decision for the. So, right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. Now, although there might be some existing, valid and compelling reason for us to include Canoo in one's portfolio, it's very important to remember that at the current, like the way things are now, the stock may not be the most optimal choice for a prolonged holding period. If your objective is to maintain a restrained exposure to the speculative aspect of the EV market, then Canoo might align with your preferences. But if your investment goal involves pursuing a more secure and enduring option, it's worth exploring other alternatives around that may better deserve your capital. I would personally recommend to commit between 0.5 and 1% of your portfolio and to split the allocation in batches of 10 to 20% at a time over the next 3 to 6 months so that you may purchase more in case it retraces.